The IRS just changed the mileage rate for 2026, and if you drive for your business even a little, this directly affects how much money you get to write off this year. I'm Isha Vabran, I'm a CPA, and every year I watch small business owners either miss this deduction completely or claim it the wrong way, and either mistake costs some real money. So in this video, I'm going to break down the new rate, show you exactly how the math works with real numbers, explain the difference between the two main ways to be able to deduct vehicle costs, and walk you through how this works depending on your business structure. And by the end of this video, you're going to know exactly how to be able to handle this on your taxes with confidence. So let's get into it. All right. So here is the headline. The IRS raised the standard business mileage rate to 72.5 cents per mile for 2026. So that is up 70 cents per mile in 2025. So that is a 2.5 cents per mile increase. And that 2.5 cents might not sound like much of a difference, but if you drive 10,000 business miles in a year, that can add up to an extra $250 in deductions just from the rate going up. If you drive 20,000 miles a year, which is common for a lot of service-based businesses, that's $500 extra in deductions simply because the rate changed. And the IRS reviews and adjusts this rate every single year. They're not picking this number out of thin air, right? They're looking at the average cost of operating a vehicle across the country. And that includes fuel prices, maintenance, repair costs, insurance premiums, financing costs, and vehicle depreciation. And when those costs go up, the rate goes up to match that. And there are two other mileage rates that also change for 2026, and people mix these up all the time. So let's be clear, right? The medical and military moving mileage is now 20.5 cents per year for 2026. And an interesting twist here, the rate actually went slightly down from last year by a half a cent. The charity mileage rate stays exactly the same at 14 cents per mile. That rate is set directly by law, by Congress, not adjusted by the IRS, which is why it almost never moves, even when the other rates change every single year. So let's make sure you know exactly which of these three rates actually applies to your situation, because using the wrong one is actually a common mistake. So if you drive your vehicle for business reasons, things like visiting your clients, picking up supplies, driving in between job sites, or running errands for your business, you use the 72.5 cents per business rate, all right? And this is one that mostly small businesses care about, right? And it's the focus of this video, right? So if you drive specifically to receive medical care, and you itemize your deductions instead of taking the standard deduction, you may be able to use 20.5 cents medical rate. But there is an important catch. Your total medical expenses have to exceed 7.5% of your adjusted gross income before any of them become deductible at all. So for most people, that is a high bar to clear. So this rate applies to a smaller group of taxpayers. So if you drive while volunteering for a qualified charitable organization, you could use that 14 cents charity rate. For example, if you volunteer and drive 3,000 miles over the year, delivering meals or running errands for a nonprofit, that works out to about $420 deduction. All right, so assuming you itemize. So for the rest of the video, we're going to focus entirely on that 72.5 cents business rate, since that is the one that has the biggest impact on your small business taxes. All right. So now here's something every small business owner absolutely needs to understand, because it's probably one of the most understood and actually misunderstood parts of the vehicle deductions, right? There's actually two different ways to be able to deduct the cost of using a vehicle for your business. And critically, you do not get to use both methods for the same vehicle in the same year, right? You have to choose one. So option number one is going to be the standard mileage rate. This is the simple method. You get to track your business miles and you multiply that number by 72.5 cents. That single number is designed to cover everything: gas repairs, insurance, registration, and depreciation, all bundled into one rate. You don't get to separately track or deduct those other costs. Option number two is the actual expense method, right? So with this method, you track every single cost of owning the vehicle and operating that vehicle throughout the year. So you got things like gas, oil changes, repairs, insurance, premiums, registration fees, depreciation, even car washes in some cases. And at the end of the year, you add it all up and then deduct the percentage of those costs that matches your business use. So let's walk through a real comparison so you can actually see how this plays out. So say you drive a vehicle 20,000 miles total in the year, and 15,000 of those miles were for business, which is about 75% business use. So under the standard mileage method, your deduction is simple. 15,000 business miles multiplied by 72.5 cents equals $10,875 in deductions. Under the actual expense method, let's say your total vehicle costs for the year, gas, insurance, repairs, and depreciation combined add up to $12,000, right? Since your business use is 75%, you would deduct 75% of $12,000, which is $9,000. So in this example, the standard mileage method actually produces a bigger deduction. So $10,875 versus a $9,000 deduction, right? But that is not always true, right? Because if you drive an expensive vehicle with high repair costs, or if gas prices are unusually high in your area, the actual expense method can sometimes win instead. So this is exactly why it's worth running both calculations before you decide, especially in your first year, you decide to use it for a new vehicle for your business. But here is the catch that catches a lot of people off guard. Whichever method you pick in the first year that you use for that specific vehicle for your business, it often locks it in to that option, right, going forward. So this decision is worth getting right from the beginning, not something that you randomly pick or switch over to later. All right, and one critical rule: if you ever claim Section 179 expensing or bonus depreciation on a vehicle, you permanently lose the ability to use the standard mileage rate for that vehicle in any future year. So you're locked into actual expenses going forward for as long as you own that vehicle for your business. So I want you to think carefully before taking a large upfront deduction and depreciation amount on your vehicle that you plan to keep driving for years. That upfront tax break can cost you flexibility down the road, right? So now let's talk about what actually counts, right? Because this is where a lot of business owners either undercount their deduction or accidentally claim miles they probably shouldn't have. So driving from your home to your regular main place of work never counts as a business mileage, right? So the IRS treats that as commuting. So just like any employee driving to a job, this is even true if you run your own business and even if you do business calls during that drive. However, once you are at your main location, mileage driven after that for business purposes does count. So driving to meet a client, picking up supplies, driving to a bank to make a deposit, all of those are going to count, right? So if you have a home office that qualifies as a principal place of business, that rule shifts in your favor. In that case, driving from your home office to a client or a job site or a supplier is considered business mileage, not commuting, because your home office is treated as your main work location. So if you work at multiple temporary job sites, like a contractor moving in between different project locations, mileage between those sites generally counts as business miles as well. All right. So miles driven between two separate jobs in the same day, say you work a day job and also run a side business, right? Can sometimes count too, depending on the specifics. All right. So this is one of those areas where it pays to be able to reach out and communicate with your CPA if you're unsure, right? And the way you actually claim this deduction depends partly on your business structure. So let's go through that, right? So if you're a sole proprietor or a single member LLC with no special tax election, you deduct your business mileage directly on your Schedule C as part of your business expenses, right? So this lowers your business profit, which in turn lowers your self-employment tax, right? That is a double benefit since the deduction reduces both your income and your self-employment tax at the same time. So if your LLC is taxed as a partnership, for instance, with multiple owners, each partner generally tracks and deducts their own business mileage, or partnership reimburses the partners directly, depending on how your partnership agreement is set up. So if you your LLC is taxed as an S corporation, for instance, the mechanics actually change. So instead of deducting mileage on your personal return, the cleanest and probably the most common approach is going to be what's called under an accountable plan, right? So under an accountable plan, your S corporation reimburses directly business miles using the IRS rate, and that reimbursement comes completely tax free. So the business still gets to deduct those costs as a business expense. You just have to submit something like a simple mileage log or an expense report to be able to receive that reimbursement, to be able to keep everything documented properly. And this is one of those small details where your entity structure quietly changes the paperwork behind a deduction that otherwise looks identical on the surface. So if you're not sure which setup applies to you, this is exactly the kind of question to bring to your CPA before tax season, not in the middle of it, right? So here is a common and connection a lot of business owners actually miss. All right. So if you expect to owe the IRS at least $1,000 in tax for the year, after withholding credits, you're generally required to make a quarterly estimated tax payments. So your mileage deduction directly lowers your taxable profit, which lowers what you owe. So if you're tracking your mileage in real time throughout the year, as I recommend you should, you can adjust your quarterly estimated payments as your deductions grows, instead of either overpaying every quarter and waiting on a refund, or underpaying and then getting hit with a penalty. So my honest advice here is make sure you track your mileage weekly, not at the end of the year. I can't tell you how many business owners try to restructure an entire year of driving from memory in March, and it almost always results in either missed deductions or numbers that probably wouldn't even hold up under an audit. All right, so let's talk about some common mistakes I see, because this is going to be important and critical for you to be able to avoid any headaches in the future. So I want you to know exactly what to be able to avoid. So number one, no mileage log at all, right? So if the IRS ever asks you to support this deduction and you have nothing written down, the deduction could either be disallowed completely, even if you genuinely drove those miles. So you want to make sure you're tracking your miles. Mistake number two, counting the regular commute from your home to your workplace as business mileage. That one is simply just not allowed, no matter how many business calls you make during that drive, right? Mistake number three, switching back and forth between the standard mileage method and the actual mile method on that same vehicle without realizing there's actual rules that's restricting that. All right, mistake number four is going to be estimating mileage at the end of the year instead of tracking it on an ongoing basis. So rough estimates rarely hold up well, and they almost always undercount the real deduction that you actually earn. So you want to make sure you're tracking that. Mistake number five, forgetting that claiming Section 179 or bonus depreciation locks you out of the standard mileage rate for that vehicle going forward. I mentioned this earlier, but it is worth repeating because it is an easy trap to fall into, right? So a couple of common and frequently asked questions as it relates to this, I get asked about some of these all the time, is do I need a special app to be able to track mileage? The answer is no, but it does help. A simple notebook, you could keep it in your glove box, for instance. That works fine as long as you record the date, the starting point, the destination, the business purpose, and the miles driven for every trip. So apps just make it faster and harder to be able to forget. Another question is, can I deduct mileage if I use my personal car for business and the car is not owned by the business? And the answer is yes. As long as you're using the standard mileage method, you're actually able to deduct business miles driven in your personal vehicle. You do not need the business to legally own the car. Also, what if I drive a lease vehicle? So you're actually able to use either method on the lease vehicle, but once you choose the standard mileage rate for a lease vehicle, you have to continue using it for the entire lease period, right? So you can't go switching back and forth part way throughout that term. All right, is parking and tolls included in the standard mileage rate? Unfortunately not. So business related parking fees and tolls are actually deducted separately on top of the standard mileage method. So you want to make sure you keep those receipts so it's not included in that blended rate, right? If you forget to track your mileage as part of the year, you want to reconstruct what you can use in calendar invites, appointment records, or delivery and client records. You want to start tracking properly going forward. It's not ideal, but partial records are better than nothing. And going forward, do not let this happen again. All right. So a few important caveats to mention before we wrap this up. So the specific rates, 72.5 cents, 20.5 cents, and 14 cents apply to 2026 tax year specifically. The IRS reviews and typically updates the business and the medical rates every year, usually announced in December for the following year. And as I mentioned, commuting from your home to your regular workplace never counts as business mileage under either method. So no matter how your business is structured, this video is for education. Your best method, standard mileage rate, or the actual expenses depends on your specific vehicle, your driving patterns, and your full financial picture. So make sure you go ahead and talk to your CPA before locking in your method for the year. All right, so here's your next steps. All right, number one, you want to make sure you start a mileage log today, right now. If you do not already have one, a simple notebook or a mileage app work fine. Step number two, for every trip, you want to record the dates and the business purpose and the number of miles driven. Number three, you want to decide which method makes the most sense. So standard mileage method or the actual expense method fits your vehicle and your situation. So you want to make sure you stick consistently with that vehicle. Step number four, if you run an S corporation, all right, you want to set up a proper accountable plan for your mileage reimbursement coming to you tax free. Step number five, you want to update your quarterly estimated tax payment once you know your mileage deduction total for the year. And that's what you need to know. All right. So make sure you go ahead and check out this next video if you want to be able to save more taxes and be able to build generational wealth. I'll see you in the next one. Take care.